Foreign equities are ownership investments in companies located outside an investor's domestic market. The program explains that international equity investing allows investors to diversify portfolios across different economies, industries, and currencies, potentially reducing overall portfolio risk and improving long-term returns. Foreign equities may be accessed through direct purchases on international exchanges, depository receipts, mutual funds, or exchange-traded funds. Because economic cycles and market conditions vary across countries, international diversification can lower the impact of domestic market downturns. However, foreign equity investing also introduces additional risks related to currency fluctuations, political instability, regulatory differences, and varying accounting standards that analysts and investors must evaluate carefully before making investment decisions. One major advantage of foreign equity investing is diversification. Different countries and regions often experience varying economic growth rates, interest rate environments, inflation trends, and industry developments. As a result, foreign markets may not move perfectly together with domestic markets, reducing portfolio volatility when combined appropriately. The program emphasizes that diversification benefits are strongest when correlations between markets are relatively low. International investing also provides access to industries or growth opportunities unavailable in the domestic market. For example, emerging markets may offer higher long-term growth potential due to expanding populations, rising incomes, and industrial development. Analysts therefore evaluate geographic diversification carefully as part of broader portfolio risk management and strategic asset allocation decisions. Currency risk is one of the most important risks associated with foreign equity investments. Even if a foreign stock performs well in its local market, unfavorable exchange rate movements may reduce or eliminate gains when converted back into the investor's home currency. The program explains that foreign equity returns consist of both local market performance and currency appreciation or depreciation effects. Currency volatility can therefore significantly influence realized investment returns. Analysts monitor exchange rate trends, monetary policy, inflation differentials, and global capital flows carefully when evaluating foreign equity investments. Some investors may use currency hedging strategies to reduce exchange rate exposure, although hedging may also increase costs and limit potential gains from favorable currency movements. Political and regulatory risks also play a significant role in foreign equity investing. Governments may impose capital controls, change tax policies, restrict foreign ownership, or implement regulations affecting business operations and investor rights. Emerging markets may face additional challenges such as weaker legal systems, corruption, political instability, or less developed financial infrastructure. The program emphasizes that these risks can affect market liquidity, corporate profitability, and investor confidence. Analysts therefore evaluate political stability, regulatory transparency, and economic policy consistency when assessing international investment opportunities. Countries with strong legal protections, reliable financial reporting standards, and stable political systems generally provide lower-risk investment environments for foreign equity investors. Equity risk refers to the uncertainty associated with owning equity securities and the possibility that actual investment returns may differ from expectations. Equity investors face risks related to business performance, economic conditions, interest rate changes, industry competition, and market sentiment. Because equity holders are residual claimants, they bear greater risk than debt investors during periods of financial distress. The program explains that higher expected returns on equities compensate investors for assuming this additional risk. Analysts evaluate equity risk using measures such as volatility, beta, and equity risk premium estimates. Understanding both systematic risk affecting entire markets and company-specific risk affecting individual firms is essential for effective portfolio management and security valuation. A strong understanding of foreign equities and equity risk is essential for global portfolio management and investment analysis. International equity investing offers opportunities for diversification, higher growth potential, and broader market exposure, but it also introduces additional risks requiring careful evaluation. Analysts integrate financial statement analysis, economic research, political assessment, and currency analysis when evaluating foreign investment opportunities. Equity risk management involves balancing expected returns against exposure to market volatility, economic uncertainty, and geopolitical developments. The program emphasizes that successful international investing requires understanding both the benefits and limitations of diversification across global markets. This knowledge enables investors to build more resilient portfolios and make better long-term investment decisions within increasingly interconnected financial markets.